Welcome to Part 3, the final chapter of our series on why companies are quietly changing salary structures before India's new labor codes take effect. In Part 1, we explained the 50% wage rule and why it is driving proactive restructuring across Indian companies. In Part 2, we went inside HR departments and showed you the 4 specific strategies being used to redesign salary packages. In Part 3, the perspective shifts entirely to you, the employee. What actually happens to your take-home salary? What improves in your long-term benefits? How do you decode the trade-off between less cash now and more security later? What special implications exist for gig, contractual, and fixed-term workers? What are your legal rights when your employer restructures your salary? And what should you actually do right now to protect your interests? These are the questions this video answers. Whether your salary has already been restructured, whether you are in the middle of a negotiation, or whether you are simply trying to understand what is coming, Part 3 gives you the practical, actionable knowledge you need. Let us get into it. Let us do a very quick recap of Parts 1 and 2 before we dive into the employee perspective. Part 1 answered the why. The new labor codes introduce a 50% wage rule. Basic pay must be at least 50% of total remuneration. This increases the base for PF, gratuity, and leave encashment calculations, raising employer costs significantly. Companies are restructuring proactively right now, before any state notifies the codes, to spread the financial impact gradually. Part 2 answered the how. We covered 4 strategies. Strategy 1, raising basic pay and reducing allowances. Strategy 2, redesigning the full CTC architecture through component splitting, expense reclassification, and tax optimization. Strategy 3, shifting more compensation to genuinely variable, performance-linked pay. And Strategy 4, using fixed-term employment contracts to define and predict long-term benefit obligations. Part 3 is the employee perspective. The gold column on the right tells you what we cover today. What actually changes on your payslip? What genuinely improves in your long-term financial security? What is the real trade-off, and how do you decide whether it works for your situation? What special considerations apply if you are a gig worker, contractor, or on a fixed-term contract? What are your legal rights? And what should you actually do right now? Let us answer each of these questions in turn. Let us be very specific about what changes on your payslip, because vague language about salary restructuring is part of what causes employee anxiety. The first change you will notice, HRA and special allowances decrease. These were the components that absorbed the large non-basic portion of your CTC. As basic pay rises to meet the 50% threshold, these components shrink proportionately. The rupee amount in the HRA and special allowance lines on your payslip will be lower. The second change, PF deduction increases. Both your contribution, 12% of basic, and your employer's matching contribution increase as basic pay rises. Your payslip will show a higher employee PF deduction, and more money will flow into your EPF account each month. The third, CTC headline stays the same. The total cost to your company does not change. What changes is how that cost is distributed internally, more into statutory deductions, less in discretionary allowances. And the net result, take-home salary decreases slightly. This is the one that employees feel most directly. Look at the illustrative example on screen. For a monthly CTC of Rs 50,000, under the old structure, approximate take-home is Rs 46,500. After restructuring under the new codes, it drops to approximately Rs 44,000. A difference of roughly Rs 2,500 per month on the same CTC. This is not a pay cut. It is a redistribution. But it feels like a pay cut, and that is why clear communication from employers matters so much. Now let us look at the genuinely positive side of the restructuring, because the story is not all negative. Benefit 1, a larger PF corpus at retirement. Both your monthly contribution and your employer's monthly contribution increase as basic pay rises. And because PF compounds over a career, 30, 35, 40 years for most workers, the long-term accumulation difference is substantial. For someone at a mid-level salary, the difference between the old and new structure could mean a retirement corpus that is meaningfully larger. Benefit 2, higher gratuity payout. Gratuity is calculated as 15 days of basic pay per year of service. At an average tenure of 10 years, the difference between old and new basic pay more than doubles the gratuity amount you receive when you leave. This is not a small number for long-serving employees. We are talking about a difference of potentially lakhs of rupees. Benefit 3. Better leave encashment value. Whether you encash leave during service, at resignation, or at retirement, the encashment value is based on basic pay. A higher basic means every encashed day of leave is worth more in rupees. The key insight: the restructuring is fundamentally a transfer of compensation from the present to the future. Less money in your pocket today, more money accumulating in your PF account, growing in your gratuity provision, and increasing in your leave balance. Whether that trade is good for you personally depends on your life stage, your other financial resources, your time horizon, and how long you plan to stay with your employer. We decode that trade-off in the next slide. Let us decode the trade-off, because not everyone benefits equally from this restructuring. For senior employees with 15 or more years of service, the picture is genuinely positive. The short-term take-home reduction is modest, but the gratuity gain at exit is very significant. The net assessment is positive. For mid-career employees with 5 to 15 years of tenure, the long-term PF and gratuity benefits are meaningful and outweigh the short-term take-home reduction. Generally positive. For early career employees with less than 5 years of experience, the calculation is less favorable short-term. Their PF has not had time to compound significantly, and they have not yet crossed the 5-year threshold for gratuity eligibility. For this group, the take-home reduction is the primary immediate experience. And for frequent job hoppers, people who change employers every 2 to 3 years, the restructuring can be outright negative. Gratuity only becomes payable after 5 continuous years of service. If you move every 2 to 3 years, you will see your take-home decrease but never collect the gratuity that would have made up for it. Now for gig and contractual workers, the Social Security Code formally covers you for the first time. Platform companies must contribute to social security schemes on your behalf. But the actual delivery of benefits depends entirely on your state's notification status, so check that. Fixed-term workers now accumulate PF and gratuity rights during their contract period. And contract staff doing the same work as permanent employees are entitled to equivalent pay structures under the new codes. Know your category. Understand your entitlements. Let us be very clear about your legal rights when your employer restructures your salary, because many employees do not know that they have more protection than they think. Right 1. The right to consent before service conditions change. Any modification to your existing salary structure constitutes a change in service conditions under the Industrial Relations Code. Your employer cannot unilaterally restructure your compensation and simply inform you after the fact. They must obtain your agreement. You have the right to review the proposed changes, ask questions, and consent before any modification takes effect on your payslip. Right 2. The right to a written explanation. You can ask your HR department to provide a written breakdown of what is changing in your salary structure and the legal basis for the change. A responsible, compliant employer will provide this promptly and clearly. If your employer refuses to explain changes to your own salary in writing, that is a warning sign worth noting. Right 3. The right to verify your PF and statutory deductions. Access your EPF passbook through the EP4 portal regularly. Your employer's contributions should be deposited correctly and on time. If the wage base has changed, contributions should reflect the change. Any discrepancy can be formally reported to the EP4. And right 4. The right to raise a formal grievance. If you believe your salary has been restructured in a way that reduces your statutory entitlements without proper consent or justification, you can raise a formal grievance, first internally through HR, and if unresolved, through the labor authority in your state. These rights exist. Know them. Use them. Let us close with 6 concrete actions you should take right now, starting today. Action 1. Check your current salary structure. Request a complete CTC breakdown from HR. Calculate what percentage your basic pay represents of total remuneration. If it is below 50%, the restructuring has not yet happened to your salary, but it is coming. Action 2. Review recent payslips for unexplained changes. Compare the last 12 months of payslips. Look for shifts in basic pay, HRA, special allowances, and PF deductions. Any changes you cannot explain with an increment letter or a written notification deserve a formal question to HR. Action 3. Check your EP4 account directly. Log into the EP4 member portal. Verify your employer's contributions are being deposited correctly and on the right wage base. This is your retirement savings, do not assume it is being handled correctly. Action 4. Read your employment contract before signing any revision. If your employer issues a revised contract or addendum reflecting new salary components, read every clause before signing. Ask questions before you sign, not after. Action 5. Calculate your long-term benefit impact. Use EPFO's online tools to project how your revised PF contributions will accumulate. Calculate the gratuity difference between your old and new basic pay at various tenure milestones. Know the full picture before forming a view on whether the restructuring helps or hurts you. And Action 6, and this is the most important one, learn the law. Knowledge of the new labor codes is the most powerful protection available to any employee or HR professional in India right now. ILMS Academy's certificate course in labor laws covers everything: the 50% rule, PF and gratuity mechanics, employee rights, employer obligations, and the full statutory framework. The link is right there on screen. And that is the end of our 3-part series on why companies are quietly changing salary structures before India's new labor codes take effect. Let us do one final summary of the entire series. Part 1. The 50% wage rule is the engine behind everything. Basic pay must be at least 50% of CTC. This increases PF, gratuity, and leave encashment costs for employers. Companies are acting now, before enforcement, to spread the impact. Part 2. 4 strategies are being deployed: rebalancing basic and allowances, redesigning the full CTC architecture, shifting to variable pay, and using fixed-term contracts. Legitimate compliance planning is very different from exploitation. The difference is transparency and consent. Part 3. For employees, take-home pay may decrease slightly in the short term. But long-term PF, gratuity, and leave encashment benefits improve meaningfully. The trade-off is real, and its value depends on your career stage and tenure pattern. You have legal rights: the right to consent, the right to explanation, the right to verify, and the right to grieve. Use them. The law is coming. The restructuring is already happening. The employees who understand what is happening and know what to do about it will be the ones who navigate this transition with confidence. If you found this series useful, please like, subscribe, and share it with colleagues who need to hear this. All 3 parts and the ILMS Academy enrollment link are in the description. Thank you for watching. Until next time.